Welcome to our market update for the end of September. We do these 6 monthly, and particularly around the end of the reporting season, there's a good bellwether as to where we think our market is. As always, I'm joined by Kenneth Beanland. What we're going to cover today is we've just gone through a reporting season, so a bit of a preview about where that reporting season or how it went. And the second part to that is actually talk a little bit about economic factors that may influence our market at the moment, and maybe a couple of questions along the way. We did do this 2 weeks ago as a live webinar, and we have had some feedback that there were some recording issues. So what we're doing today is just recording it again so our clients can have an uninterrupted presentation. So for those of you watching a second time, bear with us, but hopefully this time we'll get the recording uninterrupted. So with that, I'll hand it over to Kenneth.
Thanks, Mark. So for us, September and February are the two most important times for our market, and it's where companies come and tell us how they've gone for the last 6 or 12 months, and just as importantly, the outlook for the next 12 months. And what we saw in August was what we would say was a disappointing result season. So I'll just focus your attention down to the scorecard, which is at the bottom. What we're trying to give here is an aggregate picture of how the reporting season went compared to previous reporting seasons, so every 6 months. And importantly, down the bottom, there's the average. So the 12-month forward price to earnings ratio, you can see, is the highest it's been in a number of years. So during the August reporting season, we were around about 18.2 times. Now, what happened in that reporting season was that we had more misses than what we usually expect, and we also had less beats. So, and really, if you look all the way down those columns, it's been one of the worst reporting seasons since 2016. Now, it wasn't all bad. I don't want to get all too gloomy. Some of the larger industrial stocks actually reported fairly robust numbers. Sydney Airports, Transurban, Telstra, they're really strong bellwether stocks in our top 20, and very, very consistent dividend payers. So it was more the fact that we were looking under the hood, if you will. A lot of the mid-cap exposures on our markets, they just didn't perform as analysts were expecting.
And it probably was a couple of sector surprises there.
Certainly. I think the one sector surprise for everyone was retail.
Yep.
The consumer discretionary side, while it was on low expectations, people weren't expecting much out of that particular sector. It was one of the bright spots. We've seen companies like Noni B, Baby Bunting, both enjoyed very, very solid returns since the report.
Yep.
So. Now, this slide I think is important to have a look at, and not so much in the split between banks, non-banks, and industrials, but the combined. And what it's showing is the earnings growth. What was the earnings growth in financial year 18? The revisions through FY19, so what happened to analyst expectations from FY18 reporting season right the way through to when the companies actually reported in FY19, and then finally what's happened to the FY20 growth revisions. And as you can see, after FY18 results, FY19 looked really rosy. It looked like on a combined expectations level, we're looking at about 9.5%. But through the year, that degraded, and it actually degraded quite markedly. We ended up with around about 1 to 1.8% earnings growth for this calendar year. Financial year. Now, what's happening to the outlooks? And this goes back to when the companies come and report. It's not just how they went; it's about what they're expecting into the next 12 months. And you can see that we started really, really optimistically at 10.5% earnings growth for FY20. We've seen a marked pullback already in those expectations. We're now down to about 6.5%. and that's actually the biggest revision down in earnings growth expectations in that short space of time since 2009. So it's just something to remain cognizant of. Now we're certainly not, we're certainly not hoping that it deteriorates like we saw in FY19, but the trend doesn't look good.
Yep. So with that, throughout the 19 year, one of the big ones, particularly you can look at that chart there, the banking sector.
The banks, yes, yep. Certainly.
Bit of off the Royal Commission, bit of just sentiment in the retail space at the moment.
We believe so,
banking,
certainly. I don't think it's a surprise to anyone that what we saw last financial year was a really tough financial year for the banks. Harder to lend. Royal Commission was on. Consumer sentiment towards the banks was quite pessimistic. We actually think there's some green shoots coming out the back of FY19. So not that there seems to be a huge lax in lending standards from them, but we have had 2 interest rate cuts, and we are. In the last 6 months, and we do think that should stimulate the economy. Banks are GDP linked, and we should see some sort of growth, or we're hoping to see more growth out of the banks than we did last year.
And that might flow through to the housing market. Is there expectation?
Yeah, I suppose for us there's three issues with the housing market. One is certainly interest rates, and we think that that's going to be clearly favourable to support. But the other two that we watch, the unemployment rate, which actually has ticked up over the last 6 months, and we had another point increase just 2 or 3 days ago. So we're at 5.3%. So that's moving up. That's not good for the housing market, clearly. And the other is wage growth, and that's been pretty flat for a while.
As well, yeah.
So. Now, drilling down into what you're actually paying for on the market on a sector valuation versus their long-term average. And you can see that between the 10-year and the 2-year average on the right-hand side, there's almost every sector is trading at elevated multiples compared to their long-term. Now, given where their PE ratios are at, we think there's a lot of sectors here that are elevated. Now, there's reasons for that. We've just touched on interest rates. The 10-year government bond rate, which has risen a little bit recently to 1%, was actually under 1% through the month of September at the start and through August. So if you can't find a home for your money, where do you go? You start to flood into the equity markets. You start to take on more excess risk. And that's what's pumping up valuations. It comes back to what you're buying on those valuations, and what you want to see is earnings growth. And given that previous slide that focused on that peel back of FY19 earnings growth, we're just a little cautious that there might be some pockets that are overpaying for stagnant earnings.
Yeah, and a lot of that is, you probably have the view that it's a hunt for yield at the moment. That continues with interest rates declining.
Certainly.
And mentioned some of the outlook there that you think that's not going to change. That's certainly underpinning some of those market pricing.
Certainly is.
The valuations.
Exactly like you said. Where do you go if you're an investor that can't earn a return in their defensive assets, so just cash, for instance? You want to go into what you would perceive as safer stocks, more mature stocks that have those cash flows behind them. We have seen the banks catch a fair bit of money over the past couple of months. They've started to trend higher. We've seen the likes of Telstra, and then going back to those stalwarts that I mentioned before, Sydney Airports and Transurban, those consistent, reliable dividend earners, distribution payers, are certainly seeing fund inflows. Now, this is just an aggregate picture, and we like to show this every time that we come to do one of these presentations. All it's showing you is where our market is trading X resources compared to what's happening with the earnings per share outlook, and then the PE multiple. So what you're currently buying if you were to take resources out on the market. So if you had, say, $1 in earnings, you're paying 18 times, so $18 for that. And what you can see is the earnings per share has been deteriorating, which is not a good sign, but the market is still going up. So that's the left-hand side. The market's going up because the multiple's expanding. And if you're on a multiple expansion, you want to see earnings growth. You don't want to see earnings contraction. So it's another warning side for us that not to say that we think there's going to be a correction, but it's just going to be perhaps a tougher 12 months than what we've previously had on our market.
Yeah. So part of the key there is that even though that we've seen the PE up around 18 times, X resources, and long-term average is just above 14. It's the fact that it's not as bad that it's the multiple. It's the fact that the earnings per share growth is not there to grow into that multiple.
That's right. Yeah. That's exactly right. If we saw on that left-hand side that light blue line ticking up quite strongly, then we'd be quite happy to sit here and go, well, the multiple expansion's for a reason. People are paying more for a better, in effect, market or business. So I'll take CSL, for example, trades on a high multiple, but always delivers consistent earnings growth. And so you become comfortable paying a higher multiple for a better business.
Yeah, and that's those revisions downward that have been the concern.
Yes.
So we're looking to FY20 and hoping to see that reverse trend in that.
That's right. And look, if retail's sort of a leading indicator, hopefully it is. It might slow down a little bit, and we'll as in the earnings revision will slow down a little bit, not the growth, not the growth, and we'll see it bounce back up. For the majority of our clients, dividend and dividend sustainability is paramount. So cash flow, how we're providing income for clients is a key goal and objective of a lot of people that we see. So we thought it was, or thought it would be appropriate to show this. This is done by our equity strategy team at Morgans, and it's just alerting clients and yourself to the fact that when there's no earnings growth and dividends are not stagnant but not going up either, there's a little bit of a concern here that there may start to be slippage in the total dividends being paid. And what we're trying to show here is that payout ratio is ticking up, so how much the company's actually paying out of its earnings to its shareholders. Now, if that's going up, but the dividends are staying stagnant, which they have, there hasn't been any dividend increases on aggregate. I'm sure there's clearly pockets of companies that do it, but it is a little bit of a concern, and it's just something to keep in mind that if we don't see that earnings growth, eventually there may be a slippage in the dividends.
Yep. So an easy way to figure that is that if you've got a payout ratio around the 75% at the moment, and previously around 70%, they've increased that in order to sustain the dividend.
Yes.
They're not growing the dividend.
Yes.
So the only other equation to that is that they're going to cap out at their payout ratio because they'll need to reinvest some of those monies back into the company. And at that point in time, if they're capping out of their payout ratio and the earnings aren't going up, then if there's the only other indicator to that equation is actually cutting your dividend.
That's right, and particularly so because over the last few years there's been a big focus on cost out.
Yep.
There's only so much cost
you can cut. You've got to then drive the top line at some stage.
Yeah, exactly. So it's just something to keep in mind going forward. Now with what we've spoken about with valuation stretch, with more misses on the market than beats, we're trading at near all-time highs. It's not as if performance overall has been poor. What we believe is vitally important to concentrate on now is your asset allocation. Remembering not to take excessive risk to try and generate that extra 1 or 2% in your cash flow or in your total performance, because you feel that the defensive part of your portfolio is not returning what it once was. We think that's now the wrong time to do that, to chase the what I would or what we would say would be the diminishing marginal return of the market if there's no earnings growth. And so this is just giving you an example of the Morgan's tactical tilts and going through different risk profiles. So to give you an example, if you're a conservative investor, you don't like risk, you don't want to take on much equity volatility, so you'll have a greater weighting towards those defensive assets. Whereas right at the top end, if you're a super aggressive investor, you're not going to have much conservative or defensive assets. You're much more able to ride out volatility. You may have a much longer term investment horizon, so you can go through those market cycles, and you're happy to have an increased risk appetite. So in effect, having more growth assets.
I mean, asset allocation, or particularly active management of the asset allocations, is really one of the important ways to manage risk in this market.
Certainly is.
Yep.
Yes.
So one of the, I guess probably, if I may ask a couple of key questions that we get from our clients at the moment. One of the highly publicised one is obviously, as you can see in the top left-hand corner there, Trump-China trade negotiations. Without looking at tweets and so forth, can we cut through that? What do you believe it actually means to our market?
Certainly. It is super topical. We're getting calls on this almost daily. And it's not just us. You can see it. We sit through investment presentations. It is a concern amongst a lot of the institutional investment managers out there as well. Our view is that it hurts China a lot more than it does the US, this prolonged downturn or prolonged trade negotiations or trade war, whatever you want to call it. So we think that there will be a pragmatic outcome. Now, we predicate that on the fact that you can see that China's slowing. The data is slowing. It's out there. China knows this, and accordingly, they've acted with stimulus for their economy. So at the moment, on our market, it's actually been a bit of a uplift for the commodity sector. So, which is good. You're seeing iron ore remain elevated, while coal's come off a little bit, and copper's come off a little bit. Those major commodity stocks on our market, BHP and Rio, Fortescue, they've all performed quite well. If this continues on, however, and there is no trade resolution, it will certainly affect our economy. We are tied to China, and you will see that weaken eventually. But at the moment, we believe that there will be a trade resolution come to the fore because it's in China's best interest. Yep. Now, whether that remains, that the tensions between US and China goes away immediately, we don't believe that. We think that this will continue on.
So really part of that impact is that if China does slow, consumption of our commodities will wind back, and that will definitely have an impact on our economy.
Certainly.
Okay. I suppose there's the Europe side of this as well. Brexit, Boris Johnson. Where do we see that happening, and the impact that's having at the moment?
Yeah, it's very it's in the news daily now. Look, whether there's a Brexit deal or no Brexit deal, in the long run for the Australian economy, we can't really see a material impact there. Like how much of our Australian economy is actually affected by trade negotiations between Britain and Europe? We think there's a minimal impact there. Certainly, though, if there was to be a no-deal Brexit immediately after, so the immediate impact to global markets, to our market, we think that there'll be volatility. We think there will be a sell-off. We saw that if you go back to 2016, when Brexit first got voted in, there was about a 3-day period there where there was a huge global sell-off. After about 2 months, it was back to normal. And I suppose for us, at least our market, we think that that's where to look for a historical comparison. We think the immediate impact will be sharp, a sharp decline, but over that next 2 or 3 months, the market will digest it, and it will be onwards and upwards.
So not so much a broader market impact for us, but probably more stock specific. We've seen Link, for argument's sake, Link administration have some impact on their the administration business over
anything with pound exposure.
Yep.
will certainly be caught up in this. Link, that's actually a very good example. PWH or PWR Power, which is another stock, heavy exposure to GDP, but again, that's stock specific.
All right. So if we're talking about GDP, our June quarter came out not that long ago, 0.5%. So we had two sides of politics there, as we'd expect. The opposition with Labor saying it's a bad result. The coalition, on the other hand, being in power, saying that's a great result. So I suppose looking to cut through this again, which is politics and which is facts?
It's a good question. I think it's a bit of both. I think it's if you look on a global perspective, our growth isn't that bad. I mean, we're better than Japan, we're better than Europe, and even though we're in the middle of it, we're actually forecast to be better than the US in 2019.
Yeah.
So taking that perspective, I actually think it's an okay result. On the other side, yes, there's certainly it's been a tough 12 months for our economy. There's no getting around that. We've had tighter lending restrictions. We did have a fairly material contraction in the housing market, particularly down in Sydney and Melbourne.
Yep.
These things do hurt consumers. They do hurt the economy.
A little bit of a bouncer at the moment.
That's right. And that's exactly what you want to see from our policymakers. That through that FY19, they were seeing this, and what did they do? They acted. So we've had 2 interest rate cuts. We've had tax cuts that got brought through. These things help the economy. So certainly we're on the more optimistic side going into this financial year.
Yep. So really, it's just trying to put that GDP growth rate in context.
Yes.
So if we're seeing, I think the numbers might have been Japan 0.9% for 20 forecast or thereabouts.
I don't know off the top of my head, unfortunately.
And we're about 2.8. US is about 2.1. So in the context of that, globally, we're seeing lower GDP forecast for 20.
Yes.
And so in that respect, we're actually sitting okay amongst our peers, just not where we'd like to be.
I actually sat through a very interesting presentation yesterday on a little bit of the state of the global economy.
Yep.
And you can see it in those forward indicators, that the global PMI is starting to fall.
PMI being the
Purchasing Managers Index.
Yep.
They're starting to peel off, which is not good. We're seeing a slowdown in China in their industrial production. So it is certainly not all roses. And while 0.5 or a percentage is one of the lowest readings that we've had really since the GFC, it's not for us as bad as what it was made out to be.
And we even saw, in the last couple of days, a bit of talk about our budget as well. It's a bit of
yes, yeah. forecast for a surplus. I think we got the trade, sorry, not the trade, the deficit down to about 760 million. It was forecast to be 4.2. It's amazing what iron ore prices can do.
And I think there was a little bit of both sides too. I think things like the NDIS,
yes,
the take up in the expenditure whilst it was allocated have not been taken up as much too. So a bit of both sides of the ledger on that.
No. But they were very, very pleased with that announcement. With Frydenberg.
I think one of the other things that we hear in our market at the moment is bond yields. Now, one of the comments you made that you expect bond yields to remain low.
Yes.
That has an impact on our market. You want to elaborate on that?
Yeah. Going back to the presentation that we just went through, when investors can't get a return off defensive assets, so bonds are a defensive asset, when they can't get returns on cash, it has an immediate impact on fund inflow into the larger companies and really the super high growth companies as well. And I'll touch on that a little bit later. But so that pumps up valuations naturally. The second part to that is when you look at companies that are growing, that if you're looking out to 4, 5, 6 years and you're using a discount rate of what historically would be 4 or 5%, so where the Australian bond 10-year bond rate would be if we were living 10 years ago.
Yeah.
Those numbers, those cash flow forecasts, don't look as attractive when you're using 4 or 5%.
Yeah.
If you're using 1%, they look far, far better. So on two ways, the equities start to look more attractive to investors, and the valuations become inflated. And you can see it. It goes back to that 2-year, 10-year averages that we were talking about. They should be inflated. I believe it was Warren Buffett that said assets are 100% correlated to interest rates. So,
all right. If we think of interest rates, and we're looking at that, and we're trying to think around in the defensive asset class. Cash and term deposits are pretty poor. What are some of the other alternatives in that defensive space? Ignoring the bonds, we just went through the bonds. Carve out your cash and TDs. What are we doing in that space at the moment?
It is a tough space. There's no doubt about it. People are searching for, an extra 50 bips in returns. It is a very, very difficult space to try and look at or find attractive returns. What we're focusing on is a little bit more longer duration, so looking at those longer dated type instruments. Now, we still believe that there's value left in some bank hybrids, particularly around select exposures. So you do have to be quite selective. That's for us. For retail investors, they're still giving you liquidity, which I think is very important at the moment. There seems to be a lot of different types of management styles that are coming to the fore because they know people need or are in search of returns, and they're starting to take on risks like liquidity, where you might be tied up in debt that's not that tradable. So for us at the moment, it's about selective exposures in the bank hybrid space.
Okay, and we've that's certainly that space has had a rally since federal election, and so if I can just summarise that, I know that you were shorter dated, you were more shorter dated focused.
Yes.
Because of the uncertainty of the election and franking credits. Now that's flipped around to take the longer duration stocks.
Just lengthening out.
Or mixing it up
you
with
have
some
to,
of the shorter dated.
You certainly have to take a ladder approach to defensive portfolio construction, or we believe you do. So I'm not suggesting that you just go out and take every single longer dated instrument that you can possibly get your hands on. But for us, we believe that you're getting paid to take on a little bit longer duration, considering where we think interest rates are going, where we're not of the view that this is going to be just a short blip and you're going to see interest rates return to normal.
And I think one of the important things, if we could take something away from your comments there, Kenneth, is that it's a ladder approach, in duration, but also across the various risks in that
Certainly.
in that sector. And I think one of the comments that you made to me offline was that there's been starting to see some activity in the market where people are going for higher yields in illiquid assets.
Yes.
And a defensive space is not the place that you should be focusing on illiquid assets. It's a liquidity space that that we should be looking for in there. So
that's
one of the attributes in that is liquidity in your defensive sector.
That's my belief. What we want to be able to do in our defensive holdings is, if there is a black swan event where there is severe compression in equity markets, we want to know that we are able to sell a defensive asset for a client. I think that's paramount, because permanent capital destruction comes when you have to sell an equity or any type of growth asset at that compressed level. Yep. That's what you don't want to do. And so where do you want to take your money? If in a hypothetical situation, if you don't have the cash, you want to be able to take it from your defensive.
Yep. Okay, and I'm just being conscious of time here.
Mm-hmm.
We have some cash available. What do you do with it? What sectors are you probably finding more attractive at the moment, or focusing on risk or value? What are you looking at the moment?
I think there's two. I actually think that you're going to continue to see fund inflow into the retail or consumer discretionary space. And I'll pick a stalwart. I like the healthcare space. We saw a lot of the larger companies in that particular sector report very solid numbers. And earnings growth, and it's defensive type earnings as well. So I still like the healthcare space.
Excellent. All right. Some of the services you're offering is your model portfolios and active management.
Mm-hmm.
So if clients want to, or people would like to contact you around those.
Certainly. So as Mark touched on, I suppose what I will do is I'll run through what we're focusing on over the next 6 months first before I touch on the model portfolios. Sure. We're a little bit cautious on the cyclical type exposures. So iron ore's remained elevated. I know that there's China stimulus that's helped that, but just being cognizant of that and maybe reducing some of those cyclical type exposures, holding on or finding defensive, or highly cash generating companies that you believe, or we believe, are going to pay you income through the cycle. So we think Telstra fits that bill. We think CSL fits that bill as well. And we also like Tabcorp. People like to play the lotto, whether it rains, hails, or shines. I touched on this through the presentation. We are very, very focused on asset allocation for clients.
Yep. One thing, if I may just bring back in the conversation, and I know that we are tight for time here. And since our webinar 2 weeks ago,
yes,
we've seen an increase in tension in the Middle East, and an adjustment to the oil price in there. Where are we seeing oil at the moment?
Look, we're favourable on oil.
Yep.
After the attack. We've had a briefing on it. Our chief economist actually used to be stationed over in the Middle East, so we think that he's got a fairly good grasp of the different dynamics over there. We see oil trending towards $80 now. The supply disruptions is big, but it actually puts on a risk premium to oil now. And I think that if you're looking at that particular space, which we weren't when we originally did this presentation, Woodside and Oil Search are the two single name exposures. BHP also clearly has an oil sector.
Yep.
And then finally, trying to find the stocks that reported well, that we thought were still offering value. So the ones that we thought, ResMed, Sonic Health, and Baby Bunting.
Excellent.
I'll just quickly touch on our model portfolios. We run 3, focused on income. 1 is focused on income, 1 is focused on growth, and 1 is basically a combination, a balanced.
Yep.
There's 6 committee members, and 2 of those are actually outside our office to give a little bit of impartiality and a different view to the models. I'll just quickly go through, this is the balanced, how it's gone against the benchmark, which is the XJO accumulation index over the quarter, 6 months, but really we like to focus on that 2, 3, 5 year return.
These are at 30 June.
No.
The figures as that.
Go. This is the income, and this is the growth, and it's actually the most recent result. So they're up to August.
Excellent. All right, very good. So guys, thanks for joining Kenneth and myself. As always, if you have any queries, by all means, make contact with you. And until then, we look forward to chatting next time. Thank you.